Welcome to our COVID-19 tax update. Before I get started, let me just say I've never seen so many rapid tax changes in all my 30 years, but I never again have I've seen anything quite like the coronavirus and its impact on businesses and individuals. So bear with us as we get the information out. As of today's date, April 8th of this recording, the material that I've produced is from sources I believe to be reliable and accurate, but as always, you're encouraged to seek out additional information from other sources when looking at a specific solution for any tax situation. Before I get into the CARES Act, which is the biggest provision for the tax law change, part of this update includes what's going on with tax season, specifically the due date and the extended due dates, rather, for the COVID-19 relief. As far as tax returns and payments of tax returns, pretty much most of them have been extended. We're talking corporate, fiduciary, individuals, also gift tax returns have all been extended automatically to July 15th. This includes the first quarter estimated tax payment. I highlight first quarter because the second quarter June estimate has not been extended. Possible workaround for those clients that are making quarterly estimates. Let's say that someone pays $1,000 per quarter. What they could do if they need more time to come up with payment is double up on the first quarter estimate that's due July 15th, skipping the June 15th, and then continuing with the September and the January fourth quarter estimates for those taxpayers that need the additional time. Speaking of additional time, the valid extension is still available if someone needs that time, and now that's just time to file, not time to pay. So if someone does need the October 15th filing extension, they can still file the 4868 by October 15th. So be aware that that is still valid. Additional time also includes additional time for those people making contributions, whether it be IRA, health savings account, or even an employer with a SEP contribution. They have until July 15th to make those additional payments. What has not been extended, there's some non-filers out there that haven't filed their 2016 tax return, and this is an opportunity for them to file and file quickly if they haven't done so. Code Section 6511 allows for claim of refund the later of 2 years from the time the tax is paid or 3 years from the due date of the return. For 2016, those returns were due April of 2017. 3 years from that date gives us April 15th of 2020. So if someone has not filed their 2016 tax return, there is a cutoff of April 15th. So that gives a week from today's recording for those individuals to file and claim that refund. Now let's dig into the CARES Act a little bit, talking about some individual provisions, business provisions, and some miscellaneous tax items as well, and perspective from the IRS. As far as the CARES Act is concerned, the stimulus payment is perhaps where most of the questions are coming from, so we'll spend most of our time there. They've made some changes inside the CARES Act to charitable contributions. We'll touch on that briefly, and also some of the retirement plan changes. So the stimulus payment, many of the questions that are coming out is how much, when will I get it? These are things that certainly need to be addressed, and the IRS is working on getting those payments out as fast as they can. The credit itself is an advance credit for the 2020 tax return. So keep that in mind. This is the first time that this happened. In 2008, there was advanced stimulus payments, and everything is reconciled when you file the next year's taxes. So when we file the 2020 tax returns for our clients, we will reconcile the advanced stimulus payment that they're about to receive. How much will they receive? That's the biggest question. It's based on a formula where each taxpayer that's eligible receives $1,200. So for married filing joint, it's $2,400, plus $500 for each qualifying child. So let's dig into that definition. For this qualifying child, for purposes of dependency exemption, it's those children that are under the age of 17. So for example, if you have a 19-year-old full-time student, you can claim them for the $500 child tax credit purposes, but they will not be eligible for the stimulus payment. They have to be under the age of 17. Now, as a side note, there is some proposed legislation that would allow other dependents as eligible for the stimulus payment, but that is, again, proposed law, and quite often, and for that reason, I don't like to talk about proposed law. Things change or never become law. So at this point, only those that are under the age of 17 qualify for the stimulus payment. So who is an eligible taxpayer for this $1,200? Anyone that can be claimed as dependent is not allowed. That's unfortunately how IRS defines some of the provisions under tax law. Anyone except a dependent. So if someone is a 19-year-old who has a part-time job, mom and dad claim them as dependent or are eligible to claim them as a dependent, that 19-year-old will not get the $500 stimulus payment or $1,200 stimulus payment. Non-resident aliens are prohibited from receiving this. You have to have a social security number or an adoption taxpayer identification number. Without those, you're not eligible. Also, fiduciaries, so trusts and estates, do not receive any stimulus payment. The qualifying income is based on earned income or Social Security benefits or perhaps VA benefits for qualifying purposes. More importantly is the phase out. And there's a lot of discussion here on the phase out itself. The way the code is written, once a taxpayer's adjusted gross income exceeds a certain threshold, they have to reduce the excess by 5%. That threshold for married filing joint begins at $150,000. For head of household, it's $112,500, and for everyone else, it's $75,000. So a single taxpayer, $75,000. The phase-out range essentially is $24,000. If you take the $1,200, divide that by 5%, that gives you the $24,000 spread, $75,000 to $99,000. Once a single taxpayer hits that threshold of $99,000, they're no longer eligible. Now, let's drive that point home with a couple of examples. Let's say we have a married couple, no children, adjusted gross income of $174,000. The credit before the phase out is $2,400. If we know the AGI, the threshold is reduced, so we're looking for the excess. In this case, $24,000 is the difference. We multiply that by 5%, and our reduction is $12,000. Now, I picked, in this case, an AGI of $74,000 for a reason. That's halfway in the phase-out range of the married taxpayers. So in this case, the reduction is $1,200. The full credit would be $2,400. They're getting half of that. They're halfway between the phase-out range. So $1,200 is the credit for this couple. Now let's add to the situation. Let's assume the same facts from example one, same AGI, except these taxpayers have 2 children. The credit before the phase-out in this case is $3,400. So $2,400 for the married couple, plus $500 for each eligible child. If we use the same threshold, which is $150,000, that will not change. From our prior example, we know the AGI, so the excess stays $24,000. It's still a reduction of $1,200, but they're reducing it from the full credit of $3,400, mom, dad, and the 2 kids. So the credit that they'll receive is $2,200. So this credit phase out for a married couple with 2 children isn't phased out until you get to $218,000. It's a little higher when you have kids. For each child, if you think of it this way, a $500 credit divided by 5%, that increases the phase-out limitation by $10,000 per child. So let's do one final example here to illustrate that point. Assume the same facts from example 2, mom, dad, 2 kids, eligible for a $3,400 credit before the reduction. In this case, their AGI is $218,000. Again, the $3,400 credit is the starting point. We need to know what the excess over the threshold would be. In this case, it's $68,000. We multiply that by 5%. Our reduction is $3,400. Well, that's the entire amount of the credit they're entitled to. In other words, they're maxed out. It's fully phased out at $218,000 for married filing joint with 2 kids at that point. So what are the stimulus payments themselves based on? The IRS is going to be looking at 2019 tax returns if they've been filed. Now, there's some that have not filed, and remember, we have until mid-July to file their 2019 tax return. If the 2019 return has not been filed when the stimulus payments go out, they're going to look at the 2018 tax information. Well, what if they haven't filed for either year? The IRS then will start looking at Social Security benefits that have been paid out or railroad retirement benefits that have been paid out for that purpose. What about low-income taxpayers? This is an area where the IRS is still working on a simplified return. There are some people that are below the filing threshold. They do not and have not filed a tax return because they don't have a filing requirement. But these payments are available and they will be paid out throughout the rest of the year, so they can file a simple return. That is yet to be developed by the IRS, but they are working on procedures at this time to allow low-income taxpayers to file a simple return and get the information they need to get a direct deposit. Speaking of that direct deposit, the IRS is working on a web-based platform where they can collect that information. My hope is that they have some procedures in place to prevent identity theft when people are filling out the information for direct deposit of the stimulus payment itself. We talk about outstanding tax liabilities. I've had several clients call and ask about an outstanding tax debt that they still have. Are they going to have this stimulus payment used to offset that outstanding debt? And the answer is no. Those individuals would still get the stimulus payment. However, there are individuals that are in arrears with outstanding child support. And if that's the case, this stimulus payment will be used to offset the outstanding child support obligation. We talk about reconciliation. When we talk about the 2020 tax returns, we're going to compare the advance credit that they're about to receive to the credit that they receive with the 2020 return information. Now, there are situations where the credit could reduce someone's refund, but not below zero. So it's not going to increase a tax liability for individuals. Let's talk about reconciliation in another respect where someone might be entitled to more. With this example here, if we have a married couple with an AGI and they're under $150,000 on their 2019 return that was previously filed in February of this year, they're entitled to a $2,400 advance premium tax credit. Assume that they're pregnant and they have their first child in August, and they're going to compare their advance credit of $2,400 to what they're entitled to. Now, if that child is $2,900, since they have the 24, they'll get the additional $500 for that new child when they file their 2020 tax return. So that is something that they will not lose. They just have to wait to get the rest of it when they file their taxes next year. Divorce situations. Divorced couples, again, if they have direct deposit information on their 2018 or 2019 return, they'll put that into the bank account. Perhaps they get divorced in 2020. Half of each advance payment will be treated as being made to each spouse. So if 2,400 is deposited into the ex-husband's account, he kept that account, that could be an issue for the ex-wife. She's treated as receiving half of that, and next year they'll be filing separate tax returns because they're no longer married. Common questions. A lot of people have been asking, am I going to be taxed on this advanced stimulus payment? And the answer is no. This is a tax credit. It's something the government's paying out in advance, but not considered taxable income. Another situation, what if my 2018 income qualifies, but my 2019 does not? And if this person has not filed, the solution might be hold off on filing the 2019 return until you receive that payment based on 2018 information. I had a similar situation. Actually, in this case, it's just the opposite. A client sold 2 rental properties in 2018 that put their taxable income or their adjusted gross income above the phase-out threshold. So we rushed to get early April of this year their 2019 tax return completed, because their income is now down below, without the gain on the rental properties, is now below the threshold, and they're eligible for an advance payment by getting that under the wire. We got the 2019 tax return filed. What if I get too much? Again, we touched on this briefly. You don't have to pay the excess. It's not going to increase a tax liability. It could reduce a refund when it's reconciled, but once you hit zero, you're not going to have to pay any additional advance stimulus payments back. So when are they going to start? This is something the government's been working on fast and furious. They anticipate mid to late April for these payments to start being made, and I think there's a lot of steps involved that most people don't realize, but they are working on getting that out to mid to late April. Again, taxpayers will be able to go to an IRS platform at irs.gov, and my understanding is they're also working on tracking these payments as well, just like you can track where's my refund. Now, here's the caution. When there's available money out there, there's also people that try to scam honest taxpayers from that money. No one from the IRS is going to be reaching out to taxpayers to ask for information, bank accounts for direct deposit purposes. That is something the government does not do. So if someone gets a call or an email regarding this information, disregard, hang up, delete the email, or you could report it to the IRS, but do not engage with someone trying to get your personal information. A couple of things on the charitable contribution side. This first one doesn't surprise me. Ever since they came out with the Tax Cuts and Jobs Act, there was a drop in charitable contributions because a lot of people are taking the enhanced standard deduction since that law change, and they realize that their charitable contributions do not afford them a federal tax benefit. So charitable giving has gone down because of that. So cash contributions are going to be allowed up to a limit of $300 for public charities as an above-the-line deduction for going forward. And so anyone that makes these types of cash contributions will be able to take the first $300 as an above-the-line deduction, but that's only for those people who take the standard deduction. If you itemize, the full $300 goes along with your other contributions onto the Schedule A. Speaking of cash contribution, the CARES Act provides for an enhanced limitation. Under the Tax Cuts and Jobs Act with cash contributions, they allowed for 60% of adjusted gross income to be deducted and the excess being carried forward. Well, now they raised the bar to 100% of your adjusted gross income for 2020. If they give beyond 100% of their AGI, that excess will be carried over for 5 years, just like all other charitable carryovers. Again, it has to be a qualified contribution. The key is it's paid in cash and it's paid to a 501c3 qualified charity. In other words, a cash contribution to a donor advised fund would not be eligible for this provision. And this is something the taxpayer has to elect when they file their tax return. On the retirement plan changes, let's talk about the biggest one perhaps is the required minimum distributions. RMDs that would be otherwise required in 2020 are waived for this year. So that's all defined contribution plans and IRAs. You don't have to take a required minimum distribution. So this includes those people that turned 7.5 in 2019 and were electing to defer their first RMD in the early part of 2020. That's deferred. They've got a deferral on any distributions that would have been otherwise required for this particular year. Now, what about those people who've already taken the RMD? Perhaps they take one out at the end of March systematically from their IRA. Well, they have 60 days to roll that money back in, so it would be treated as not as a taxable distribution if they put that money back. Now, many people may argue and say you can't do that. Well, typically you can't roll over a required minimum distribution. But for this year, the rules have changed. The required minimum distribution is not required, so that changes the rules for rollover purposes. So they could put their money back within 60 days. Another question that has come out recently, and this ties into this Secure Act. What about qualified charitable distributions? For those people that are not aware, the Secure Act changed the required minimum distribution age to 72 for those people who have not each reached age 70 and a half by the end of 2019. So in a situation like that, what if they were doing the qualified charitable distributions, taking the money right from their IRA and paying it directly to the church? Well, if they use that age 70 and a half, they would not offset the RMD. They can still do the qualified charitable distributions, but there's no offset because there is no required minimum distribution to take for the year. The same would be true for 2020. The 10% penalty, yet another exception. For the CARES Act provides a Code 72T exception to the 10% penalty for distributions up to $100,000. Now, this distribution is only for 2020 for a distribution from an eligible retirement plan, and it has to be a qualified individual. Essentially, this anyone who's has the virus, diagnosed spouse or dependent is diagnosed with the virus, or Category 3 opens it up quite a bit. You don't have to have the virus, just have to have adverse financial consequences. Maybe you're working reduced hours, you're laid off or furloughed from your job. You're afforded that waiver of the 10% penalty. As far as proof goes, the plan administrator has to rely on the employee's certification that they satisfied the condition. So gets a lot of people out of the 10% penalty on those distributions. Now, what if someone did take the money out and they want to put it back? They have 3 years to avoid paying tax on the distribution. So they can put it back over the next 3 years. And as far as the people that don't put the money back, they get to spread the recognition of the distribution they did take over 3 years, unless the taxpayer elects not to. Now, a situation like that, maybe they expect their income to be up over the 2021 and 2022, and they're in a low situation. They may want to recognize that all in 2020, but they have to elect to report it all in 2020. If they don't, then it's going to be spread out over 3 years automatically. There are people that take loans from their qualified plans, and the Act provides a little bit of flexibility for those individuals. If they have a current outstanding loan against their 401k, they have an extra 1 year to delay making those repayments. That's basically any loans that have been taken out as of the date of enactment, and by definition, it was signed into law March 27th and ends on 12/31 of this year. 1 year delay for making those payments. And for those people that are looking to take a loan, new loans made within 180 days of enactment will be treated as a distribution if it will not be treated as a distribution as long as it's under $100,000. That doubles the previous rule, which limited it to $50,000. It's now $100,000 for any distributions made in 2020. A few business provisions to touch on. Again, specific to the business owner, loans can be taken out from the Small Business Administration, and some of these are eligible for forgiveness. Now, not all of them are. There are a few, like the Economic Injury Disaster Loan, not eligible for forgiveness, but the PPP loans that we'll talk about are eligible if they're used for permitted purposes. They are eligible for exclusion of debt discharge income rules. The debt itself has to be in a window from February 15th to the end of June to qualify for this exclusion, and it's only available for small businesses. This is a Paycheck Protection Program loan. Small business is defined as business with under 500 employees. And they can apply for a loan up to 2.5 times their average monthly payroll cost, or $10 million. So it's the lesser of those two amounts. We said it has to be used for the proper purpose. What are the permitted purposes? Expenses like rent, utilities, not the principal payment, but the mortgage interest payment, and then predominantly to pay for payroll cost. And it also includes continuing insurance premiums or the cost of group health care benefits during paid sick leave. When we receive these loans, we talk about getting that forgiveness. Some businesses are looking to cut staff or limit hours. If they reduce their workforce level or their gross pay after February of 2020, February 15th now, they're only eligible for limited forgiveness. So it could reduce the amount that they're going to be forgiven unless, and this is the exception to that rule, if they restore their workforce level or the gross payroll to the pre-COVID-19 emergency levels by the end of June, they're okay with the complete exclusion of that loan. There's also an employee retention credit eligible, again, just for employers who qualify for up to a refundable credit against the employer's portion of Social Security payroll tax or railroad retirement tax on payments because of the COVID-19 situation. But you can't take this credit if you get a paycheck protection loan. A lot of people have already filed with their local lender to get a paycheck PPP loan. If that's the case, then that retention credit is not available. If they are going that route, there's actually a new form issued by the IRS, Form 7200, affords employers the ability to request an advance payment of those tax credits for retention wages that are paid. Once we know what the tax liability is, there's also a provision in the bill that allows for delayed payment of employer payroll taxes. So the taxes that we determine are due in 2020 can be deferred until 2021 and 2022. So they're spreading that over the next couple of years. And self-employed taxpayers can divert 50% of the self-employment tax until 2021 and 2022, respectively. But once again, if we get a paycheck protection loan and that's forgiven, we cannot defer the payroll taxes. So understand the consequences of getting a loan. Some people are taking the loan before they go for the tax credits or the deferral of the payment. Some other provisions inside this bill deal with NOLs. Now, this might afford some planning opportunities with businesses that perhaps they want to go back and free up some money a lot faster. Under the Tax Cuts and Jobs Act, when we talk about NOLs, they basically eliminated the ability to carry back NOLs, and they limited 80% of the NOL to 80% of the taxable income of the carryover year. Well, essentially in the CARES Act, you can carry back the NOL for 5 years and you're not limited to 80% of the income. So effectively, it's delaying the rules under the Tax Cuts and Jobs Act to NOLs till 2021. So if someone had a net operating loss in 2018, 19, or 20, they can carry that back 5 years and perhaps free up some money a little bit faster. Some miscellaneous provisions we should be aware of as well. There's a provision that allows for $5,250 of eligible student loan repayments. This can be paid for principal and for interest of the employee's student loan, and also excluded from taxable income. This is only for 2020, but there's a caveat to this. There's no double benefit. If my employer pays for my student loans and student loan interest, I can't take a student loan interest deduction when I file my individual tax return for 2020. But, and nor should I, because I didn't have to pick up the income. Limited assistance, again, we have to recognize what the IRS is going through. They are practicing social distancing and closing down some of their service centers. Practitioner Priority Service Line and the local taxpayer assistance centers are unavailable at this time. So it makes it difficult to work with clients and to get things resolved with the IRS. They are still accepting mail, but you can imagine that's going to take even longer than before. But bear with them until they further notice those are unavailable. Hopefully they get them up and running soon. Part of the People's First Initiative suspends a couple of compliance programs that we should be aware of. Let's talk about first, existing installment agreements. For those people that have been making those payments, anything that's due from April 1 to July 15th is suspended. So that gives people more time to make those payments. If you're pending offer and a compromise application is out there, they're not going to close any request for an offer and compromise before July 15th without the taxpayer's consent. So essentially those are on hold as well. Taxpayers have the option of suspending all payments. If they're dealing with an offer and compromise that's been accepted, they can suspend that until July 15th. But keep in mind that interest will continue to accrue on those payments that are not made. We talk about new offer and compromise application. The whole idea is to help individuals get a fresh start when they find themselves unable to pay their tax liability. I suspect because of the coronavirus and individuals cutting back on or getting their wages cut or significantly reduced, there could be an increase on offer and compromise applications, account values dropping as far as investments and or retirement plans. I believe some individuals will look to offer and compromise to settle any prior outstanding tax debts. So that, unfortunately, will probably be on the increase going forward. Field collection activities. We talk about liens and levies, whether it's initiated by a revenue officer or it's an automated lien or levy. This is all suspended during this period. So a quick overview, if you will, of the COVID-19 tax update. For those people looking for additional information, we do have a free tax newsletter that comes out every month. You can follow us on Facebook for that, or go to our website, btbtaxlink.com, for additional information. And we will have some specific details for those people that come to our seminars in Wisconsin and Arizona. The live seminars at this time are still on schedule. We optimistically hope that this will be resolved by the time we start those seminars. But for additional information for now, follow us on Facebook or on our website. First and foremost, I want everyone to stay safe and stay positive. And as more information evolves, we'll try to get that out to you with additional newsletters and or webinars. Thanks.